Hi, David Bruty from the Escala Partners CIO team, and I'm joined today by Reece Birtles, who is the portfolio manager for the Martin Currie Equity Income SMA. How you going, Reece?
Morning. Thanks.
Reece, the SMA portfolio outperformed quite well in a weak reporting season through August by more than 1%.
Yep.
So what were the key drivers or stocks and sectors behind that result?
I think the positive results reflected to a degree some good stock results, but also some of the defensiveness of the characteristics of the portfolio. So JB Hi-Fi had a really good result in terms of delivering sales growth, delivering earnings growth, doing a good job of competing against other retailers and Amazon, and had a good trading outlook based on July like sales. Other names probably look a bit more defensive rather than necessarily having stellar results. So Spark New Zealand, the telecom company, has got a very strong market position, has grown free cash flows into their dividend, and has a very positive outlook for that continued growth in free cash flow. And then other companies that probably look quite a bit more defensive. So Coca-Cola, Contact Energy in New Zealand, the utility market, and we're really our skew away from the more cyclical names actually help the portfolio as well.
Dividends and capital management were again a feature of reporting season. How much capacity do companies have for dividend growth over the next 12 months, or do we require better earnings growth to materialise?
I do think we need some earnings growth. The payout ratios on stocks is quite fine. They've been quite stable. If you look at the broad market payout ratio, you might think that the payout ratio has been rising, but really that's driven by resource stocks, which are not the type of equity income names that we invest in. So the payout ratio on resources has been rising a lot, but on real assets, so infrastructure, utilities, property, it's been quite stable. On the financials, it's been quite stable, and the financials probably got a little bit of pressure, especially in the bank space. And then the industrials, the low growth environment means that they're not as investing as much in capex, and it does mean they're throwing off a fair bit of free cash flow. So from here, I think it's when you look at the quality companies that are doing well, that are growing earnings, such as a JB, that they delivered 7% dividend growth in the last 12 months. They'll continue to deliver dividend growth based on that earnings profile.
Cyclicals and value stocks have traded at a widening discount to defensive and high growth as interest rates have continued to fall. How have you reacted to this persistent trend?
We're building a portfolio with good yield potential. Sort of that forward yield is still over 6.3%. But we also want to be in quality companies. We don't want to take too much risk on the spectrum. We want the portfolio to be defensive. So I guess when I look at our trades, they reflect those two characteristics. Keeping the yield in the portfolio means we have a valuation discipline. So the stocks that have done really too well have rated too much compared to their dividend. We have been reducing the weight on. But on the other end, we haven't been buying higher risk, high yield names. We've sort of been looking more in the defensive space. So Spark New Zealand has been a name that has really been growing in the portfolio. And G8 Education, childcare, their growth is really is much more defensive and based on new centre openings in terms of expanding earnings. So maintaining valuation discipline, trying to keep the yield and the quality characteristics of the portfolio, and just avoiding those weaker companies given the risks in the economic outlook.